Thank you everyone for coming. I'm starting over for the recording. Thank you to Tilde for providing excellent interpretation as always. And if you are looking for the webinar on preparing 2024 taxes as a worker-owned cooperative, you're in the right place. If you are an LCA, if you are an LLC, if you are an S corporation, if you're a nonprofit, welcome. We'll get to all of you cooperative corporations too. I just wanted to say this webinar is being put on by the U.S. Federation of Worker-Owned Cooperatives. We're the national grassroots membership organization for co-ops in this country. And our mission is to build a thriving ecosystem for worker ownership. And the way we do that in part is by helping you get the resources you need to file your taxes. This webinar is part of the Co-op Clinic, which is our training and technical assistance branch of the Federation. We provide technical assistance and training through our network of peer advisors who are excellent worker owners themselves, who provide culturally affirming services. And as a member of the Federation, you receive regular support via many channels for accessing our staff and other members, such as Slack, and reduced rates if you did want to do technical assistance or training with one of those peer advisor worker owners. And then we do regular technical assistance workshops such as this one. So I'm thrilled to pass the mic to Andrea Roldan, who agreed to guide us through the various forms and patronage allocation options that you're facing as worker owners. And with no further ado, thank you so much from Maureen in the Co-op Clinic in Tiwa Territory in northern New Mexico. Thank you everyone for coming, and thank you, Andrea, for facilitating today.
Of course, thank you guys for putting on this training as a part of the clinic for everybody to attend. My name is Andrea Roldan, and I'm one of the lead CPAs at the ARCPA group. We have been helping cooperatives file their taxes, provide bookkeeping support, consulting, and guidance for half a decade. And then outside of cooperatives, we've been doing taxes, bookkeeping, and other financial work for more than a decade. So we want to say thank you all for allowing us to provide you this support through this training. And so what we are going to start with is to give you an idea of what you can expect during the training. What we're going to start with is definitions and important keywords that you should be aware of. We're also going to talk about what your year looks like in business prior to filing your taxes. And then we're going to talk about what forms you actually file and what the tax filing looks like as far as compliance, timing, and presentationally. We're going to have a brief Q&A section, and then we're going to talk about patronage allocations, right? That's the distinguishing feature of a cooperative corporation, a cooperative partnership, people who are in worker cooperatives. So we'll talk about patronage. We have a couple examples for you that we hope are going to be really helpful. And we have another Q&A as well as personal considerations for individual tax returns. But this training is primarily focused on the business filings, not the individual filings. So we'll briefly talk about those, but mainly the business side of it. So we're going to jump right into the definitions. The first one I want to make clear for people when we talk about patronage allocations, what that refers to specifically when we use the word patronage is if you are taxed as a subchapter T cooperative, that's if you're formed as an LCA in your state, or if you've made the election to be taxed like a subchapter T cooperative with filing the form. Patronage is the allocation of profit, right? That's an IRS term. During this webinar, we are going to use the word patronage, referring not only to the allocation of profit when it comes to cooperative corporations, but for partnerships, technically, partnerships have to allocate loss as well. So when we refer to the allocation of profit or loss for partnerships, that's how we're going to be using that word interchangeably. Subchapter T, I've mentioned it's the tax code that governs filing as a subchapter T cooperative, right? When we use that term, it's different from it's the set of rules that governs filing taxes as a subchapter T. That's different than filing as a partnership. It's different than filing as an S corp or a 990. So that's a very specific like set of rules when we refer to that. Partnership and S corp, like I said, each tax code governs the different types of filings, but both of those, the partnership and the S corp, are flow through businesses, right? So that any activity that happens at the business level has to be reported on the individual return. If you're a member of a partnership or an S corp, your taxes are not independent of the business. They're actually dependent on the forms that you get from the business to file your return. That's the flow through. And then one of the things we'll talk about later, the benefits of being a cooperative, is the FICA tax, avoiding the FICA tax. And what that is, when we refer to that, is the Social Security and Medicare taxes that are taken out. What you're probably most familiar with if you're looking at a W-2 is it's box 4 and box 6. If you're basing on your own personal experience, that's those taxes they say they're taking out of your check before you get your portion. So we'll talk about that, but that's what that means when we refer to FICA taxes. Then we'll segue into here what we call your full year in business, right? So we're going to go into detail about what tax returns you file, but before you get to the point where you're filing your tax returns, you're operating a business, right? Members have come together, they've formed their entity, they've marketed their services to clients, closed deals, collected revenue, they've paid for a website and an accountant, a lawyer, you're running the actual business. That's where we say you have your business activity, right? So you're running the actual business. As you're doing that, your bookkeeper or one of your members or your CPA is also managing your finances, right? So whatever happens in real life, the sales that you make, the expenses that you incur, they should show up on your financial statements through your bookkeeping. And so that's where we say, like, after the actual business activity happens, your finances are where all of that is going to get reported, right? It's going to get put on paper. And so what that is, those are your financial reports. Those are your bank reconciliations. That's your cash flow management reports, any data that you can use to assess the health of your business, right? To get an idea on paper of what the actual performance was from the business. And so once you have the finances and a whole year is finished, right? You finish your tax year, you're going to segue into filing your taxes, your income taxes, filing your W-2s if you have any, filing your 1099. And so that's that third box on the flow chart where we get into compliance, right? So you've ran your business, you've reported everything on your finances. Now we're leading into the end of the year where it's time to deal with compliance. And a few key things that we want to point out for compliance is January 31st is a major deadline for 1099 filings. If you have paid vendors more than $600 or contractors, that's the same deadline for W-2 reporting if you have employees. And also patronage forms. If you have patronage forms for members, you would file all of those by January 31st. And then there are different deadlines we'll talk about with each tax type, each tax form. So the first one we're going to talk about is what we call the subchapter T cooperative. This is applicable for organizations that are either formed in their state as LCAs, or if you're formed in your state as an LLC, you can elect to be taxed like a subchapter T cooperative. So the 1120C is the tax form that you would file. And then Maureen, can we go to the next slide? Yeah. So the 1120C is the form that you would file if you are taxed under subchapter T. A few key points about filing this form and compliance related to it is the first deadline, the original deadline for filing the return is April 15th if you're taxed under subchapter T. If you file an extension, the deadline would become October 15th. That's a 6-month extension. When you extend, there aren't any fees to extend necessarily, but if you're projected to owe taxes, you would want to pay those taxes, right? So you can extend the time you have to file. And if we're recommending you extend, it's because we want to make sure your books are correct. We're looking for more deductions, right? Or we need more time to wrap it up. And so you may pay what your estimated taxes are, and then when we extend it, we're hoping that that time we use to extend it is to lower the tax bill by having more deductions or more tax strategy. So the key thing about this form is that it can't be filed electronically. It must be filed with paper. Unfortunately, the IRS doesn't have a schema for this form type yet. When I mentioned patronage before, which is the allocation of profit for subchapter Ts, if you file as an 1120C, you don't allocate losses. That's a feature that only applies to partnerships. If you're an 1120C filer, when we say allocating patronage, it's only allocating profit. If you have a loss for a certain year, the loss stays with the company. You just carry it forward to the next tax year, but you don't actually allocate it to the members. The other big benefit of filing as a subchapter T is that your share of the profit, your patronage, is not subject to FICA taxes, right? So when we talk about the taxes that they take out from your check or your earnings, the portion that you get that is considered patronage, the allocation of profit, you're saving a little bit more than 15%. I think the number is 15.3% because you're not paying FICA tax on that amount. And then because we're only allocating the profit, we're not allocating losses, you can file your individual return even if the business return is extended or it's not yet filed. Your business return as a member of a cooperative and your personal return are two separate filings. If you're a cooperative corporation or you file under subchapter T, you don't have to wait for documents from your business return to file your personal. And then the one main thing to keep in mind, if you're allocating patronage, which is, profit to its owners, is anytime you do that, you have to distribute to the owners 20% of the amount that's allocated to them in cash. So I did want to do, if we have enough time on this slide, if you could, Maureen, click the form 1120C just so we can get a visual. I like to just explain to people that the 1120-C is a particular form. It's different than the 1120 or the 1120H. It's specific to cooperatives. If you scroll down just a little bit, just to show the income is all reported at the top. The expenses all show up at the bottom. And then line 25A and 25B is where if you have taxable income, this is the amount that you would have available to allocate to owners. That would show up on 25A. It's all of your income minus your expenses. 25B is where if you have patronage to allocate to members, you take that as a deduction. So for example, if you had a profit of 100,000, you allocate 100,000 of patronage to members, you take 100,000 away from the $100,000 profit, and now your corporate profit is zero. So I'm not going to put the examples on the form, but just explain it that your income minus your expenses is your profit minus your patronage allocation. So that's how you can get your corporate tax down to zero and distribute profit to owners. And so the next business type that we're going to talk about is filing the partnership return. And this applies if you are organized with your Secretary of State as a general partnership, as a limited partnership, as an LLC. I think those are the main types. The most common one you'll see these days is the LLC. When you file at the state, you're starting your business. If you choose the LLC structure, and you don't elect to be taxed as a cooperative corporation, or if you can't elect to be taxed as a cooperative corporation, you would be filing a Form 1065. And so with this one, the initial deadline is March 15th. So for those that file a 1065, your deadline is actually not March 15th this year because it falls on a weekend, I think. So it's going to be the 17th. It's pushed back a couple of days. But generally, the deadline is March 15th. Unless you extend it, you can file an extension and it'll push the deadline to September 15th. So that gives you 6 more months to file. Similar thing as with the extensions for the corporations is you file the form, it gives you 6 months to finalize the tax filing, except in this case, if you extend the partnership return, and it goes beyond 4/15, if it takes longer than April 15th to finalize the partnership return, the individuals may need to extend as well. So if you extend on March 15th, you should still have a push to finish and finalize that return by April 15th. Because in the case of a partnership, the individuals actually rely on what we call a K-1 from the business to file their individual returns. And so some of the distinctive features about a partnership is that all profit and all losses must be allocated to members, right? So different than a subchapter T where you're only allocating profit to members. In this case, all income, all expenses gets allocated, right, to members. And then any profits that you receive if you're a working member of a cooperative are subject to FICA taxes, right? So there's a slightly higher tax rate, that 15%, because your profits are subject to FICA. Again, you can't file your personal return without getting the K-1. And in this case, if you're a member of a partnership, you don't put yourself on payroll. There's a section on the K-1 that you get where the payments that you make to yourself as an owner are reported on your K-1. So that simplifies your reporting. You don't have to put all the members on as payroll and file quarterly payroll taxes. You would report the payments to owners on the K-1. And then Maureen, if you could click the form 1065, I want to do another visual, not that one, but the K-1. I want to start with the partnership return first. Yep, so just to explain the differences, this is basically LLCs, general partnerships. It's a different form than the 1120s. So this is the 1065, very similar. If you scroll down, all of the income shows up at the top. All of the expenses show toward the middle and the bottom. And then you end up with your total profit, line 23, like your what they call ordinary profit. And that's the amount that gets allocated to owners, whether it's a profit or loss. So whatever that number is what you're going to see your portion of on your K-1. And so if you go back to the slides and you click the K-1, there's if you look at it like the 1065 is the business return that includes all of the data. The K-1 is like your portion of that. So the 1065 includes everybody's portions. And then from the total portion, whatever shows up on your K-1 is representative of your portion of the business activity. So if you scroll down to part 2, where it says information about the partner, that's where your name will be. I mentioned earlier that if you're a general member of the LLC and you're performing services and you take part in generating the revenue generally, your income is subject to FICA taxes. But if you look on section G, you have the option of being marked as a general partner or as an LLC member manager. Those are the ones that we consider like the ones who are involved and actively participating. The other option is you can be marked as a limited partner or other LLC member. That would be somebody who is using it as an investment. They don't take part in everyday activity. They're a passive member. Maybe they were a former member they're a member that used to provide services and has stopped providing services, but they still remain a member. They may be marked as a limited partner. And so which box is checked is dependent upon whether your portion is subject to self-employment taxes. And then over on the right side of the K-1 form, if you scroll back to the top, Yep, where it says the partner share of current year income, deductions, and credits. Box 1 is where you're going to see your profit or loss. Box 4A is where you're going to see payments to yourself for the services you perform as an owner. And this is the form that you're going to use when you prepare your individual tax return. You can transfer every item from box 1, box 2, box 3 into your own return. If you tell your personal software or your CPA that you have a K1, you can essentially transfer all the data directly into your own return. And so we're going to move on from the 1065 over to the next form type, which is the S Corp. This one, similar to the partnership because it's a flow through. The initial deadline is March 15th. If you file an extension, it'll take you to September 15th. You get a K1 as well as a member of an S Corp. If you click on that one, Maureen, I want to point out that the K1 is actually different. So make sure whatever version of the K1 you're given, or if you're preparing your own taxes, up on the top left, it says Schedule K1 Form 1120S. The one for the partnership would say K1 1065 for the partnership return. And so you can close this one. We'll jump back over to the S Corp slide. I'm not going to go into a ton of detail because S Corp is not a very common tax type, but the initial deadline would be March 15th. Once the business return is prepared, we want to send all the owners a K1. The S Corp has a few limitations that make it less attractive to a lot of people to use as a business type. One, it's that you can only have 100 owners. You can't go beyond 100 owners in an S Corp. There are some exceptions and some particular rules to that, but generally the rule is 100 is the limit. You can only have one class of stock. So unlike a lot of worker cooperatives that may have like a class A stock for worker members, a class B stock for investor members or community members, you can only have one class of stock in an S Corp, and all the rules that pertain to that stock have to apply to everybody, unlike a worker cooperative where each membership class can have different rules. And then this one as well, you can pass losses over to the owners. But let's go to the next screen because these two are they're not as common for worker cooperatives. So we're just gonna do a brief overview of these. So this one is for nonprofit organizations. If you would know if you're a nonprofit, you wouldn't accidentally file one of these if you start your return. To become an IRS recognized nonprofit, you would form your organization with the state, and then you would file an additional form with the IRS asking them to become an official nonprofit. And once you do that and you receive a letter of confirmation that you are an IRS certified nonprofit, you file these forms. It's 3 different versions. So it's either the full 990 tax form, it's either a 990 EZ, or it's a 990N. And which version you file depends on how much revenue the nonprofit brings in. The nonprofit deadline is the furthest of all the deadlines. It's the initial one is March, the second one is April. This one is May 15th for the original deadline. With the 6-month extension, it extends to November 15th. And if you can click the Form 990, Maureen, I'll just point out that you do file this return, and it's a heavy return. There's a lot of information if you're filing the full 990, but primarily if you scroll down, outside of page 1 and 2, where we summarize the income, the thing about the 990 is a lot of the information is meant to convey what your mission is and how you're accomplishing your mission. So there's like this page here, and I think the page that follows, it's checklist, right? It's a bunch of checklists to report how the organization operates, how successful it is in achieving its mission, what rules are in place in managing the company, because 990s don't pay taxes, right? So we're not filing a form generally to figure out the taxes. We're really filing the form to be accountable to the public, right? Because most 990s accept or most nonprofits accept funds from the public. We want to be accountable to them by sharing our tax return with the public, and these are published on the IRS website. If you could jump back over, Maureen, to the slides. Yep. So, filing this form, it does contain financial information, but primarily it's meant to share information about the organization, what it's accomplished, and how it operates, and who's operating it as a form of transparency to the public. And I did say generally nonprofits don't pay income taxes, but there are some situations where, depending on what's reported, there may be taxes assessed, depending on what activity is taking place with the business. So I believe that's all of our, does that take us to, oh, there's one more form after this one. Yep. So this is not actually a tax form, but this form is the one where I mentioned if you organize in your state as an LLC, generally you would be taxed as a partnership by default. But this is the form, if you file this form, this is the one that you would tell the IRS that you want to be taxed not like a partnership, but as a subchapter T cooperative. So if you click it, Maureen, I just want to show people what it looks like. It's not really complicated. The first page is, yeah, if you'll have to scroll down to the second. It's not super complicated. It's maybe 3 pages of actual input. But this is the form that you have the option with the IRS to say, hey, we're an LLC. We're going to remain an LLC in the state of California or the state of New York, but we want to be taxed like a cooperative. So we're going to be an LLC that files an 1120C, right? So this is the form that you would use. And if you go back to the slides, there are a couple rules about when to file and whether you can file. But the main one to remember is you can file this form generally anytime after you've started the business. They prefer that you file it as soon as possible if you start your business and you know that you want to change your tax type. You would file this form. But if you don't file it the first year or the second year, you can file it in later years. And it's a one-time filing. You don't have to do it every year. But you can file it in later years as long as you file it before you file your income taxes for that year. So if you are an LLC and you want to be taxed under subchapter T and file an 1120C using the cooperative rules, last year you might have filed a 1065 by March 15th, but if you file this form 8832 before March 15th, and well, I guess at this point you may have to extend your return. But if you file this return in January or February, sometime early in the year, you can change your tax type so that even if you filed a 1065 last year, after filing this form, you can change your tax type to be an 1120C. So as long as it happens before you file the actual return, you can modify how you're taxed. And then I think, is that the last one? Yeah. So now we have time for questions.
Luis, did you want to ask your question?
Yes, that is when an LLC selects subchapter T, does that mean its members must be treated as employees instead of being treated as partners?
Yeah, so that's a good question. The question you're asking is if you're an LLC and you file the form 8832 to elect to be taxed under subchapter T, the important distinction there, and the reason it's a good question, is when you're taxed like a partnership, your members are considered self-employed, right? They're the owners of the business. They receive K-1s. The payments that they receive as owners are reported to them on a K-1. Once you change your tax type to be subchapter T, which is a corporation, you're changing your employment type as well, because then the people who work for a corporation are no longer considered self-employed. So if you're working for a corporation, employment law says that yes, you have to be hired then as a W-2 because you don't get a K-1 to report your earnings. Does that make sense, that answer?
Yes, exactly. Thanks.
Yeah, so you would have to, if you switch to become a subchapter T from a partnership, it does change how you report earnings to owners, and you would subject yourself under employment law to now have to be taxed as employees rather than self-employed owners.
I see
So one,
in the chat. I'm going to read
are
out
you
loud.
referring to Andy?
Yeah, for the sake of it being interpreted, there's a question. When you file 8832, I don't see an option to choose between different corporate subchapters.
Yeah, so that's another good question. You don't actually choose the subchapter. There's a box on there. It's somewhat limited of your 6 options. There's a box that says, and I don't know if Maureen, if you want to pull up the slide for that one, the form. I think the box says domestic corporation. Not that, yeah, it'll be the 8832. So the box that you would check is the one that says tax me like a domestic corporation. We'll just walk through this question in full. So it's page 2, or like scroll down one more page. Yep. So type of entity, you have 6, I think it's 6 options there. 3 of them are related to foreign entities, so you can ignore those. But the first one, where it says we are an association, which is also considered an LLC, you're an association. What does it say? Domestic entity electing to be classified as an association taxed as a corporation. So if you want to be taxed under subchapter T, that's the box that you would check. If you're an LLC, a partnership, a limited partnership, any other organization type. And then if you go back, Maureen, to the 1120C slide, I just want to walk through this question on all of the tax forms. So it's the 8832, you'll check that box, you'll send it to the IRS. And then once we get to go back 2 or 3 more. Yeah. And then on the 1120C, if you scroll down, I think it's 3 pages in. If you just scroll, I'll tell you when to stop. There's it's past 5, past the balance. Here we go. So somewhere on Schedule K. Can you do a control find for the word cooperative? I gotta remember where it's at. So there's a question on, there you go. Is it 4? No, that's not it. Fine, keep going on the search. Next one. Next one. Next one. I'm looking for the box that says, next one. Next one. No, maybe, yeah. So on this one, so what you'll do, I don't think they have the question on this one. It's actually on the regular 1120 filing. So once you check the box on the 8832 that says you want to be taxed as a corporation, what that does is it changes your tax form number, right? So if your form number used to be a 1065, it's now 1120. But the 1120s have multiple versions, right? There's the regular 1120, which we don't have an example of because it wasn't included in this. But on the regular 1120, there's a question that says, are you operating on a cooperative basis? So if you want to be taxed like a regular 1120, you would file a regular 1120 and you would check that box. If you are filing you're still taxed as an 1120, but you want to be taxed as a subchapter T cooperative rather than a regular corporation, you file the 1120C because it's still the 1120 form, right? Does that make sense? So it's like once you say tax me like a corporation, the form that you file next dictates to the IRS which type of corporation you are operating as. And so if you file the regular 1120C, you would check the box saying you're operating on a cooperative basis, which we don't recommend because the forms are different. You can file the 1120C if you're a worker cooperative, and that tells the IRS that, hey, we chose to be taxed like a corporation and our specific type is a cooperative corporation. The other types of 1120s, you can Google these. It's 1120H, 1120S is technically a corporate return. I think there's one more, like 1120. There's some other version too. There's some other code. but it's like the 1120 is the form series, and then whatever dash code comes after it, code letter S or C is the one that you would file. I think HOA is one of them, 1120-HOA, or 1120H. So does that make sense? Does that answer your question? It's like you check the box to tell them you want to be taxed like a corporation, and then whichever version of the corporate return you file after is further communicating whether you're a cooperative or a normal corporation. Did we get a thumbs up on that? Does that make sense? Or do we need, let's see, an option to choose corporate subchapters? I think we're ready for the next question. Susan?
I have a question. My name is Blanca from OSHA Solutions. I have two questions. First, we already did our taxes. When we did the taxes, they give a little individual form for the members. So the question is, if a member, a worker owner of the co-op worked the 30 days of the month, and a different worker owner of the co-op worked 1 week, that is paid based on work, but on the taxes, there's an equity, the 25% to each, because there's 4 members. Is that right?
Can I ask Blanca, did you all file a partnership return, a 1065, before I answer?
No. We're an LLC. So based on that, there was some taxes. The LLC doesn't pay taxes, but when they give back the individual form, we have to pay. But the question is, someone works 30 days a month and gets paid for 30 days a month, but the person that only worked 1 week charges 1 week. When we get our individual forms, it says that we have to pay, there's an equity of 25% for each of that amount of what's been paid or charged. Is that correct? Or would it be according to the portion or the part that each person individually is earning?
Yep. So we will actually discuss those, how to allocate profit for people who work more or less or different hours in the second part of our presentation. So I'm not going to go into too much detail about that, but I do want to clarify for your question, the sake of your question, Maureen, if you can go back to the 1065 slide, because if you're an LLC, by default, you would file the 1065. And the form that Blanca is referring to after she files the business and each member gets their part, that's the K1. So I want to kind of visually show what she's asking about. So on each member's K1, if you scroll down past the information about each partner, item J, scroll up a little bit. Item J. So her question is in reference to how the profits from the business is allocated to the owners. And so in item J, if you're a member of a partnership, you're going to see percentages here, how much percentage of profit you have the right to, or what your share of the profit is, what your share of the loss is, and what your share of ownership is. In normal partnerships that are not worker cooperatives, it's very common that the profit, the loss, and the ownership is the same number. When it comes to a worker cooperative, it's very common that the ownership is divided equally, but to Blanca's question, the profit and the loss is oftentimes not divided equally. That's what makes worker cooperatives unique as a partnership, because the way you allocate profit is based on what your organizing documents say, what your, partnership agreement says. If the partnership agreement says that everybody shares profit equally, regardless of how much they work, then that's how it'll be shared. If the partnership agreement says, you know, it doesn't matter if it was 1 month or 1 week, it's based on how many hours you worked. We're going to divide the amount of the profit based on your portion of total hours worked. That's actually the second part of the presentation. We go through those examples. But does that make sense in answering just briefly? Like, it depends on how the agreement states that profit will be allocated. And we're going to give some examples of what that looks like. But if somebody only worked 1 month and somebody worked 1 week, I would expect to see the profit allocation be different numbers, not equal, based on how most worker cooperatives divide their profit. They use their patronage allocation or their patronage metric, and whatever that metric is how we divide it. So that question will be answered more so toward the second part of the presentation in detail with examples. But I just want to show where her question kind of stems from. If you're getting a K1 from a partnership, item J is going to tell you your share of the profit, your share of the losses, and then your share of the capital. But we'll talk in detail with examples about what that looks like later.
Está bien, gracias.
Of course.
Susan, if you want to ask your question, and then we have a question from Luis in the chat, and then if we have time, Taylor.
Great, thank you. So I work with a worker-owned cafe that in their first year filing as a cooperative, they filed as an LLC partnership and did the 1065. And I'm curious if they in both last year and then this year have had a loss as a business, so there's not an opportunity to take advantage of, like, you know, receiving patronage dividends. And so I'm just curious in that case whether it would make sense if there's any benefits for them filing as a subchapter T, or if that's really only if you're looking, if a business is in a position where dividends will be distributed.
Yep. So to restate your question, it sounds like you're asking if you have this new business that's like a startup or a new business and they're not profitable, they've been taking losses, would it benefit them to file under subchapter T or to continue filing as a partnership? Was that a good summary of your question?
Yeah.
Yep. So that's actually a great question. And I checked one of the later slides to see if we were going to cover that, but that tax strategy part was left out, unfortunately. So I will answer that question. I'm glad that you asked it. What we usually advise, in your case, I think the part you would definitely want to make sure you understand and you do research about after is filing the Form 8832. Because what we advise people is in the early stages of the business, if you're taking a loss, especially if you're taking a loss, remain a partnership, right? So if, I don't know, you can go 5 years taking a loss and the losses are going to flow through to the members. Depending on each member's personal situation, they may not want to see losses, especially if they're trying to apply for a mortgage or they need to have a high income on their personal return. But allocating the losses to owners, for a lot of people, that could be a beneficial situation, right? It lowers their taxable income. It lowers their overall tax. If they're a member of the worker cooperative and they have another job, the loss nets with their job, so it lowers their taxable income. We tell people to stay a partnership until you become profitable. Once you become profitable, that's when you should file the 8832 to be taxed as a subchapter T. If there aren't as many losses after doing that, you won't have losses to carry forward on the corporate side, right? But you will get the benefit when it's time to allocate profit of not paying that 15% tax on the profits. So in summary, for early year businesses, you know, first 5 years especially, if you're taking a loss, stay a partnership, let the losses flow through to the owner so they can benefit from the losses. Once you turn the tide and you become profitable, consistently profitable, we recommend filing the 8832. And Susan said, thank you for that. So did we have another question? I saw a question about.
I'll ask Luis's out loud for the sake of time. Does Partnership LLC need to distribute in cash all allocated equity? Can it retain 20 to 80% in a revolving fund?
And this question specifically is about partnership worker co-op, not subchapter T.
Yes.
Yep. So to answer first on the partnership side, technically, all profit and loss is allocated to partners, even if none of it is distributed to them. There's no minimum requirement to distribute cash to partnership owners. You can retain up to 100% of it if the company wanted to and if the members agree, right? Because you have your operating agreement, and I'm assuming you guys are voting on what to do financially, financial decisions. But there's no minimum requirement to distribute cash to a partner. They get taxed on their portion of profit, even if they don't get any cash. So to answer the question, yes, you can retain 80 or 100%. There's no minimum and there's no maximum. The big difference I want to clarify is if you're a subchapter T cooperative that files a corporate return, that's where that 20% minimum comes from. If you are allocating patronage on an 1120C, any amount that's allocated to a member has to be paid 20% in cash. That's the only requirement to pay it in cash, but there's no other, that requirement doesn't exist for partnerships.
We have 2 more questions in the queue, but only 3 minutes, so I think we'll likely only get to the next one, and then Pedro, I'll ask your question in the next round. This is a question from Taylor. Does filing an 1120 with an election of subchapter T corporation /1065 result in different tax treatment and differential tax rates?
I would say yes. I'll try and answer this question quickly in case we can get to the second one. Yes, the biggest difference if you choose to file a subchapter T is you're not going to be subject to FICA taxes, right, at the individual level. So that's 15%, 15.3% saved right there. Also the thing about 1120C, we didn't have time to go into a full example, but if you allocate patronage, it's taken as a deduction on the return, and your taxable income on your return could be 0. So you don't pay any corporate tax, no business taxes. Most corporations, other corporations don't get to do that, right? They don't get to deduct their dividends, but worker cooperatives can. But the difference between a worker co-op and a partnership is if the worker co-op taxable income is brought down to 0 and the partnership income is all allocated to owners so that it's taxed at the owner level, that is basically an equivalent, right? So that's not a savings, that's just a different treatment. But generally the biggest savings, the biggest strategy there is having your share of profit not be subject to FICA taxes. And then you also get what's called QBI, which is an additional 20% of your profit be deducted on your personal return. But to answer the question, I think in short, the best answer would be filing as a subchapter T saves you 15% or more of taxes. And I didn't get a chance to say this earlier, so I want to say it now. There are limitations. Maybe, I don't remember, maybe it wasn't on the slide or we took it off, but if you're an LLC, if you're formed as an LLC, you cannot convert to a subchapter T cooperative if you have, Maureen, help me out here, non-resident members? Is that the word, non-resident members? Yes, so remember if you convert to a cooperative, you subject yourself to employment law. Every member has to be employable. The corporation has to be able to employ them. So if you have members who cannot legally work in the US, you cannot convert to subchapter T, having those members. So if your membership includes people who are not legally allowed to work in the US, then you should remain your original filing type.
Thank you for including that. And there's one question that I hope is quick before we move on to patronage allocation. If a co-op reimburses members for mileage at a rate higher than the federal mileage rate, should the excess amount, 30 cents per mile in this example, be considered taxable income? And should members track their mileage separately as reimbursed at the federal rate and then the excess differential?
For the sake of time, I want to ask if we can push that question to the next question segment, just because I want to get through the patronage example without losing time up front. So whoever asked that question, I will try and get to it on the second side, but I do want to start
Cool.
the patronage part, and then we'll circle back to that question so we can pull up the examples, and I might have to do some research on that too. So let's circle back to that.
All right.
Are we ready, Maureen? You have the questions? We'll go to the next slide. Yeah. So we're going to talk about patronage allocations. It sounds like people have a good understanding of what we mean, right? You're allocating profit from a subchapter T, or you're allocating profit and loss from a partnership cooperative. And so we're going to give you two examples, what that looks like. I know one of the questions that arose, if you go, Maureen, to the next slide, was one of the ways you can allocate patronage. And whatever this allocation is, by the way, is based on what your agreement is with your members, right? So if you have an operating agreement, if you have a patronage and dividend distribution policy, whatever document and whatever agreement you guys have made, if you take a vote every year at your annual members meeting, it's whatever the agreement is. And so one example of that, I think this came up in Susan's question, is if it doesn't matter how many hours people work, we're going to agree to divide profit equally, right? So we all get paid for the hours that we work, but whatever our total profit is, we're going to divide it equally. And so in our example, we're going to say that our total profit is $5,000. We have 4 members, and we just agree that every hour that each member worked, they were already paid for, either through guaranteed payment or on their W-2. And whatever our profit is, we're just going to divide amongst everybody. If there's 4 members, then every member gets 25%. Everyone gets the same amount. That's the first example. There are different ways to allocate. So the second example we're going to use is more common with worker cooperatives. It's I don't want to say the number one method, but it's the one that we see the most when we work with cooperatives, is the fact that people can work a different amount of hours. They might only work part of the year. We're going to divide the profit based on how many hours you work, right? So this is, again, after we've all been paid as a W-2 or as our guaranteed payments as an owner, right? Our payments as an owner. This portion is just the profit, what remains after all of our income and all of our expenses. So if our profit, again, is $5,000, we have 4 members. Member A, or person A, worked 125, the next person 750. What we do to figure out the share of profit is take each person's hours worked divided by the total hours worked by all members, and that gives you the percentage. So if you took 125 divided by 39.55, you would get 3%, so on and so on. It's whatever share of hours that you work divided by total hours worked. That becomes your share of profit. And so what in our example, it says person A worked 125, you had 3%. And so that's the second way that you could do it a number of ways, but this is our second example using just hours worked. And we're going to head into the third example we have for you. But before we do that, there's a slide. I just want to explain what you guys are going to see. Yeah, so just for comparison, again, the first example is equally no matter how many hours worked. The second example is using only one factor, how many hours you work. Your percentage of total hours worked is your share of profit. The example we're going to show you now is what we call multi-factor patronage. And so this means that we're going to allocate profit based on the percentage of either hours worked as one factor or any other factors that we have to base our patronage on value that's contributed for the company, right? So hours worked is a measure of value that's contributed. You can have any number of other factors, right? So it could be hours that you worked, it could be sales that you generated in dollars, sales amounts you generated. It could be clients that you helped bring to the firm. It's whatever metrics you guys use to measure the value that you create rather than just one metric. So hours worked is one metric, and then we're going to add another layer in where we use two metrics in this next example. So we'll go to the next slide. And this is, we're just showing, or I guess it is the Excel are we going to do, or just look at it on the slide? Just look on the slide. Is it visible to people? Maybe we should zoom in or, yeah, is it? Yeah, okay. So is that, might have to scroll up a little bit, yeah. So same example as before, we have a profit of 5,000, but instead of using only one factor to allocate profit, which is hours worked, we're gonna do a multi-factor example. So instead of just being hours worked, one of our factors is gonna be how much revenue was generated. And the other factor is going to be how much time you spend developing the co-op, right? So we'll call that internal hours or admin hours. That could be attending meetings. That could be attending trainings to get better at your job. That could be designing the website, right? Whatever work goes into admin of managing the company. That's factor 2. And the first factor is revenue generating hours. So in our example, we take the total number of hours that you saw on the first slide by each member, but we're now dividing the total by how much of the total is revenue generating hours and how much is admin hours, right? But it's still the same total hours worked, except what we do is we're going to take the total profit and whatever percentage we decide goes to each factor. In our example, we're going to say 70% goes to revenue generating activities, and then 30% goes to administrative activities. And so if you look at our example, I like to point out two members. The first member, person C, they worked full-time. They worked 2,080 hours. That's a person C in both charts. 2,080 hours is full-time, but 100% of the time that they worked was administrative. That's like having a front office person, a desk person, somebody answering the calls, somebody taking notes during all the minutes. 2,080 hours. Under admin, 100% of their hours are grouped in admin. They don't show up in the revenue generating chart because they're not a salesperson. They're an admin person. So if we look at admin hours, that person C, worked 80% of all admin hours. So they're going to get 80% of the admin portion of profit. And so our admin portion of profit, we've decided is 30% of the total. 30% of 5,000 is 1,500. So they're going to get 1,198. Sticking with that same person, if we go back to the slide before just person C, we're going to go back like one or two slides to the hours worked example. So the reason we're showing you the multi-factor here is this person C technically worked the most hours out of everybody, but they did all admin hours, right? So if we were only using hours worked as our factor, technically they worked 53% of all hours. That's the majority. And so they would take home $2,630 of the total 5,000 profit because they worked 53% of the hours. But if you jump back over, to the multi-factor example, in this example, their total take home, if you look at the top chart, they're not on it. They don't get any portion of the revenue generating. The internal admin chart, they get 80% of the amount allocated to admin. And if you look at the total down at the bottom, their total take home is 1,198, which is less than what they would get if we were only using hours worked, because in this case, we're stratifying profit into different buckets. And so a person that, they work more hours, but they're not hours that generate revenue or sales, they're still going to get credit for, but we're going to divide the credit based on how we segregate out the profit. The other example I want to show, not just person C, but person B is similar to that, except person B only works revenue generating hours. They don't, for whatever reason, they don't do any administrative hours, right? Any administrative hours. So person B, if you jump back first to the first example, person B worked a total, not the first one, I'm sorry, the second one. Yeah. Person B worked a total of 19% of all of the hours in total. They would have taken home $948 of profit based on 750 hours. But if we go back to the example, multi-factor, person B, their 750 hours were all revenue generating hours. And because we've decided that revenue generation gets 70% of the profit, they worked 750 out of 1350, which is 56%. So they're going to take home 56% of the amount allocated to revenue generating portion, which is 1944. If you see person B in the second chart, they didn't work any admin hours, so they're not going to get any share of the admin allocation. Down in the total, if you look at their total take home, it's 1944. And because I've already forgotten the number, I do want to jump back one more time and look. So using multi-factor, they take home 1944 or 1900. Using only hours worked, they would only take home 948. So using multi-factor patronage, I think it's the second one, slide 21. Yeah. So using multiple factors when we allocate somebody's patronage is a way that we can more evenly, I guess more fairly distribute profit to the question that was answered earlier, right? If somebody only worked 1 week and somebody else worked for 1 month, how would that show up if we're only using hours worked, right? If the person that worked 1 week worked 40 hours in that 1 week, but the person that worked 1 month only worked 5 hours a week, that's only on average 20 hours in a month, right? Even though they worked the whole month, it was only 20 hours. So if we're using hours worked, technically the second person who only worked for a week would get more of the profit because they worked more hours, 40 versus 20. And this example isn't the one from the screen, it's the one from the question earlier. But if we have multiple factors of patronage, maybe how many months you've been a member, how many clients you've helped bring to the company, you can see that there's a lot more math involved, but you could redistribute equity in a way that's more fair. And an example we use to people is imagine a member of your worker cooperative. You know, they've been a member for many years. They helped build the company. They worked consistently for many years, but then they go on maternity leave. Right? So if they have a medical issue or they have a baby or they're on maternity leave, they can't work as many hours while they're on maternity leave. And so if we're only using hours worked, then they're not going to get as much share of profit, right? It kind of penalizes a person who can't work as many hours, right? But if we use multiple factors, we could say, well, some of the profit is based on hours worked, so that person might not get as much of that share. But if they're on maternity leave, but they're still getting us clients, they're still making sales calls, their friends are still coming from referrals, then they can still take home a share of profit based on the revenue that they helped us generate, even when they couldn't work any hours, right? So that's our patronage example. Do we have, I think, questions after this, or do we have, let me see. Yeah, we have questions. I know that was a lot of math, so we want to pause and kind of talk about that.
We did have one holdover question from Pedro from before about mileage. And then we have a question from Nika in the chat as well. You can choose which one to address. Nika's question is, do members' capital contributions need to be reported in Form 1065 for LLCs? And then we can move on to questions about patronage. Thank you.
I do, to the person who asked the question about mileage, I really hope we can get to it during the webinar, but I do want to save it for the end because we're kind of in a flow and I know a lot of questions might come about patronage. So I want to stick with these questions first, and then we'll circle back to that. And if I have to hop on a call with you after privately and do some research with you, we can definitely do that. But to the question about member contributions on 1065, the answer is yes. And I always like to provide visuals. So Maureen, if you could hop back over to the 1065 slide and pull up the K1, the partnership K1. It must be slide 12, yeah. So K1 at the bottom. So the question was, do member contributions need to be reported on 1065? Because you use the word need, I do want to clarify that technically, no. They don't need to be reported on 1065 because there is, it's called like a safe harbor. If the gross revenue of the company, this is all income without any deductions, is less than, I think it's 250, it's either 120, I think it's 250, then they don't need to be reported. Capital contributions don't need to be reported. In fact, if gross revenue is less than $250,000, you don't have to file a balance sheet and you don't have to track member patronage, technically. Do we recommend that you track it and you should always report it? Yes. So let me show you where that would show up if you scroll down past the percentages that we talked about earlier. Yep. Section L. So section L is where you would report not only contributions, but also distributions. So what I tell people is if you're a member of a partnership, think about your partnership interest the same way that you would a bank account. So Maureen, if you could type, I mean, I guess you don't have to type it, but if you could. So I always say, like, if it's in your first year of business, the beginning capital account, unless you made a contribution, it would start at 0, right? That's your beginning, the first year that you start a business. Then you contributed $100. Every member contributed $100. Current year net income, your share of the net income is let's just say $700 for easy math. No other increases or decreases, nothing to explain. You didn't take any distributions. To the previous question, are you required to distribute cash? No. So we're going to say there were no distributions to you. Your ending capital account is now $800 at the end of the first year. When you start next year's K1, the 800 is going to be at the top. And then any contributions that you added will be added in. Any distributions are going to be taken out, so treat it kind of like a bank account, just like you start with 0, then you make any contributions, and then your direct deposit might come. That's like your share of the income. And the thing to remember is when you have distributions as a partner, this is why I say it's like a bank account. When you have distributions, and you have like capital contributed and you have profit allocated to you, you don't pay tax on those distributions. That might be opening up a whole new can of worms, but that's different than like allocating profit, right? So if you have profit allocated to you and we recorded your contribution, and then like, let's say year 1, you had 700 allocated to you for profit, but nothing distributed. And then year 2, you had $300 distributed to you. It lowers your partnership balance from, what do we end on, 8? So it'll lower your ending capital to 5, but you don't pay tax on the $300 because you already paid tax on it when you got your K1 the year before. But to answer your question briefly, it's not required to report capital contributions unless gross income is more than 250, but we always recommend it just because whenever, partnerships can get whenever somebody comes or leaves the partnership, we want to know exactly what their ending balance is. So we recommend doing it even if it's not required. Let me do some research then, since there aren't any questions about the patronage so far. Actually, Maureen, you may be able to do this well, let me find it first, and then I'm trying to look up the question about the mileage reimbursement. But if we have any questions about the patronage examples or any other examples from your own co-ops that you want to ask about regarding patronage, feel free to do that now. In the meantime, I'm going to try and research that mileage question because I don't give the wrong answer.
I did want to share that in the co-op clinic, we do three free 30-minute intakes with co-ops across the country for technical assistance. And we got this question about different ways to distribute patronage a lot. And what was most interesting to me in hearing what you presented is that often with co-ops that set a salary hierarchy due to the different types of labor in their co-ops, using the multi-factor patronage distribution seems to be a way to potentially value types of labor that aren't valued higher at their salary rate or hourly rate at the end of the year. So it could be a way where people make more doing certain types of labor, for example, a master electrician as opposed to a journeyman, or a doctor as opposed to a nurse practitioner. But then at the end of the year, you can potentially address those discrepancies in your salary in a co-op to show you value other types of contributions, like attending co-op meetings or revenue generation or direct client interfacing. So from someone that talks to co-ops a lot, I found that really interesting as an answer to give.
And just to add on to that, the other thing outside of differences in pay or work performed is I think what I think about it in regards to cooperatives are like life changes, right? So like it provides some flexibility when the circumstances in your life change, where you don't lose your ability to take part in the company that you might have helped build because you can't work as many hours anymore. Kyle has a question about patronage distribution.
Yes, can you
And
hear
then
me?
Susan has one. Yes, Kyle, I can hear you.
Yeah, I was wondering, within our cooperative, actually, I did want to say, Maureen, we do the exact thing here. We're a worker co-op that does engineering and manufacturing at Isthmus Engineering, and we have a very large array of technical skills, and so we do just that, and it works well. My question was regarding patronage distributions from the company. Is there any like restrictions as far as government or tax forms as far as a ratio of patronage versus W-2 wages when you are paid a W-2 but also get distributions as patronage?
Your
Is
question
there
is, can I
sorry.
rephrase it to see if I understand what you're asking?
Sure,
Or like
yeah.
to summarize it? So your question is, if you're taxed under subchapter T and you're allocating payments to members between like a W-2 or patronage, is there anything similar under subchapter T is what I think a lot of people refer to with the S corp of like reasonable compensation allocate? Is that where that question comes from? Like the S corp
Yes,
treatment?
just to make sure, like, if at the end of the year, because sometimes given profits aren't always known at the beginning of the year, but there's times where you don't make a huge patronage, but then there's other years that we might have a very large patronage, and the ratio in comparison with the W-2 wage is sometimes much larger. And I've never really heard anything of any sort saying, well, you're paying too much in patronage, not enough in W-2. But I have heard from tax preparers that they do not like certain ratios being too high.
So that scenario of like you're paying too much in patronage versus W-2, I'll rephrase the language. It's not always patronage or sub T. That way of thinking for decades has come from S corp treatment, because I don't want to say it in a bad way, but like people take advantage of the S corp rules because S corps are similarly favored when you allocate profit. You can avoid FICA taxes. And so for most people, it's thinking of like especially the IRS, they go after people who allocate too much for S corps as profit instead of pay, right? So there's all these kind of like concepts of what is reasonable allocation to make sure that if you're an S corp owner, you're paid enough on a W-2 to justify the work that you do, and the position that you hold and the expertise that you have, and you're not pushing too much of it into profit to avoid tax, right? That's where you'll get in trouble a lot of times if you're an S corp. But I dropped, to answer your question specifically about patronage, sub T and patronage, I dropped a link in the chat. Maureen, if you could click the most recent one. It's the IRC code 1388. Yeah, just to put that on the screen. And so to answer your question and kind of describe, there's no, as far as I know, there's no recommended ratio, but I will tell you what the IRS uses to measure patronage, and anybody can look at this. It's online. It's a part of the tax code. And so in order for a patronage dividend to qualify and have the benefits of like avoidance of FICA and be treated as an actual patronage dividend on the corporate return, it has to meet 3 requirements, right? So if you look at what's called the patronage dividend, it has 1, 2, 3. The first one is that it has to be based on the value, the quantity or the value done with or for the patron. So that's the business and the member. So in some of my examples, I say like you want to base your patronage on what measures produce value, right? That's kind of the language I was using. So if it's hours worked contributes to value. If it's clients closed, that's a measure of value. If it's, right, it's like however you measure value production or value generation in the company, that's the first prong. The second prong is that the obligation to pay it had to have existed before you knew the amount that was to be paid. So to your point, like we don't always know what our profit will be at the beginning of the year. That's why the IRS wants to see bylaws or a policy or, some obligation that the company had to its members prior to knowing what the profit was and prior to, paying people their W-2 so that it doesn't get abused. Like I can't say that's their reasoning for that second prong, but if I have to pay you that amount before I know what that amount is, it's kind of set in stone and less likely to be manipulated the way the S corps are. And then the third one is that patronage, your share of patronage has to come from profit, right? So that's that distinction of like, you're going to get paid a certain amount as a W-2, you're going to receive a W-2 for that. Those are taxed subject to normal taxes, right? Income tax, Social Security tax. Then you may also get a 1099 patronage form that is only supposed to represent your share of the profit. And so that third prong is like, patronage, we don't want to start manipulating. If one year your W-2 was $100,000 and your patronage was only 10, because that was the profit, but the next year your W-2 dropped down to 50,000 and your patronage was, 80, that might cause problems, right? So this is just to give everybody the link and the reference from the tax code of like, what patronage is and what's required to qualify as patronage treatment, right? To be considered a patronage dividend. It's that it has to be based on the value created to the company by the members, if we're interpreting that first line. The second is that the obligation to pay it had to exist before we knew the amount. And then the third one is that the amount has to come from profits, right? So if we start manipulating W-2 payments to people, that could get us in trouble. Is that helpful? I don't know if that's like a concrete example, but is that helpful?
Yeah, that cleared it up very well. Thank you very much.
Of course. Maureen, you were going to say something?
We have a question from Susan, and then we have a question from Luis, but as a time check, it's your choice as facilitator if you want to skip personal considerations and address the next 2 questions, and then we can wrap.
Yeah.
That slide
I would rather address the questions, the personal considerations. People can read the slides and you can show them as we're wrapping up toward the end, but I think the questions are where the most helpful to people.
Susan, take it
So
away.
what was
Thank you,
that?
Andrea.
Sure. Just thinking about in the situation where there is a worker owner who leaves the co-op, but still, over the course of the year is still receiving a K-1 in this case. Just considerations for, do co-ops ever shift the percentage allocations of profit and losses on the 1065 to account for the time at which they were no longer associated or were no longer a worker owner?
Am I understanding your question that you're saying when a member leaves, do you skip their portion of the profit allocation or?
Do you shift the percentages to account for them leaving mid-year?
Yeah, so Maureen, if you go back to just the 1065 slide, I don't know if we'll pull up the tax return, but so when a member leaves, to restate your question and answer it, is, you're saying if a member leaves during the year, do we shift the percentage of allocations to that person to account for the fact that they left and not allocate, profit that was generated after they left, or account for people that have joined halfway through the year, they don't get profit that existed before the year? And the answer in both of those scenarios is yes, we would shift the profit. But actually not this slide, Maureen. If you go back to maybe just the hours worked slide for an example, because it'll help us with my explanation. Yeah. So let's say, for example, in that partnership, we allocated profit based on just hours worked, right? Simple allocation of hours worked. If you have a member leave during the year, you have to do what's called a technical termination, right? So if you're a partnership, what that means is, if you have a CPA that says, hey, send me your financial statements and we'll prepare your tax return based on those financials. Usually the financials are based on December 31st of that year, or like whenever your year end is, and it's the whole year. Anytime you have a member leave, and we're doing the patronage allocation, what's called the technical termination means that we have to run the financials as of the day that that person left and allocate our patronage, including to them, as if we were like closing the business, or as if we're just like allocating it that day. So we're going to run our financials. I actually just prepped a return like this recently. Somebody left on May 27th. So I can't just use the financials for December. I have to use the financials, one version for May 27th, and we have to figure out how many hours everybody worked. If we're using this example, we're going to allocate all of those amounts as of the day they left. And then like after they're gone and we have our new membership base, we're going to run new financials from May 28th or whatever the next day is until the end of the year. And then reallocate those amounts to each person based on the hours worked during that period. So I guess I would describe it as like anytime a member leaves or a member joins, you create two separate periods of financial reporting. And with each period, you have to allocate everything as if they're like their final K1, their final day as a member. And then you kind of start a new period the next day. So our recommendation to people as you're helping develop cooperatives or you're starting your co-op in the beginning stages is we recommend to people, whether through the bylaws or through policy updates, is only to allow or recognize admissions and departures once or twice a year. So for example, instead of having like one member left on May 27th, we have to wind everything up and allocate it. A new member joined on June 5th, so we have to do a 10-day financial period and allocate everything. And then somebody else left November, like you don't want to do that to your CPAs. They're probably not going to keep you as a client, or to yourself. So what we recommend is like anytime somebody gives notice that they're leaving, write it into your bylaws that you recognize admissions and departures on July 31st or December 31st or whatever days you choose. That way, if somebody says, hey, I'm leaving April 1st, you're recognizing their departure on June 30th. So you can do like half the year, everything gets allocated. And then you limit the number of periods that'll be created based on departures and admissions, if that makes sense. So to your question, yes, you do have to allocate. Like when somebody leaves, you have to allocate based on the day that they left. And when somebody joins, you have to allocate based on that day. But we recommend like setting it up to where there's only so many days that people can choose to leave.
There's one more juicy question in the chat, but unfortunately we're at time. So I wanted to say, this slide deck will be emailed to everyone as well as the recording. I'm so grateful you all followed so attentively to ask so many good questions. And there are links within and what I just put in the chat to schedule the free hour consult with Andrea. And thank you for so thoughtfully addressing every question we did have time for, Andrea. I put the evaluation, or Theodora shared the evaluation in the chat. Please let us know what was helpful, what you would have wanted to change. And if you accessed interpretation in this call, please also evaluate Tilde. And we can hopefully address the questions from Luis and Pedro that are in the chat in the follow-up email that you'll get. Andrea, if you wanted to say any closing words before I share upcoming events.
No, that's all I was gonna say. Yeah, if I could collaborate with you to, if you can record those questions that weren't answered, and then we can try and get them answered and sent to people. But yeah, thank you all for the great questions. I love the engagement and the questions.
Thank you all for coming. Like I said, this will be
Muchas gracias, buena información.
gracias a usted. We have some upcoming events. If you're interested, next week there's a session on asset protection for immigrant entrepreneurs. And then the regular recurring meetings of the Federation. You can find all of these on our website, usworker.coop. And thank you for being here. We're going to stop the recording, but we'll share it with you and see you soon and answer any pending questions in the follow-up. Thank you, everyone.